We're fortunate to have Dr. Bob Hartwig, who is a clinical associate professor of finance in the Moore School of Business at the University of South Carolina and the director of Risk and Uncertainty Center at the University of South Carolina. Before that, he had previous positions at the Insurance Information Institute and NCCI. Today, Bob will provide a broad look at the workers' compensation ecosystem, labor markets, wage trends, regulatory and political environments, the impact of inflation, tariffs, monetary and fiscal policy, and workers' compensation outcomes. We can always count on Bob to help us separate the signals from the noise. And with that, please join me in welcoming Bob Hartwig.
Thank you. Thank you. Well, thank you for that very kind introduction, Ramona. And I am a born and bred New Englander. I wasn't born too far from here, actually, and I went to college here, lived here much of my life until I went off to graduate school. So it's good to be back in the snow and see the frozen Charles River out there. I haven't seen that in quite a while, to be honest with you. We don't have many frozen rivers in Columbia, South Carolina, I will tell you that, though we did have actually a little bit of snow this year ourselves. But again, thank you for having me here. It's very much my pleasure. And I think it's been a number of years since I've actually spoken at this conference, and like anything in the property casualty world, things have really been changing and changing at a fairly rapid pace. And one of the things I'm going to talk about is how workers' compensation has been changing within the overall property casualty insurance environment. And in ways that are a little bit unexpected, and I think that ways that people who have been around for a while, certainly people who've been maybe attending this conference 10, 15 years, really could have never known or really have foreseen. So without any delay, let me get into that. And by the way, this presentation is already available on my website at USCRiskCenter.com, all one word, USC Risk Center, all one word.com, under the presentations tab, and I'm sure WCRI will be distributing that as well. So let's talk about workers' compensation in the property casualty universe, and what we're actually going to see is that this line is materially smaller than it once used to be. But it's still, I will call it mighty, all right? So we'll refer to it that way. And then in the greater property casualty insurance universe, which is now $1 trillion plus universe, where there is a major cyclical shift underway, but it's one that has largely left workers' compensation on the side. So that's kind of interesting as well. And then we'll talk about some of these major economic drivers affecting workers' compensation recently today and going a little bit forward. Again, there's a lot of issues out there these days. And then I'm going to end on the question of whether or not there is an AI apocalypse about to take down the property casualty insurance industry and workers' comp and labor markets all around, all with it, okay? So we'll end on that pleasant note, all right? There's probably smarter people across the Charles at MIT could pontificate about that better than I could, but at any rate, we'll have some questions and maybe no answers, but we'll have some questions afterwards at the end. So anyway, let's get right into it. Property casualty insurance world over the past quarter century or so, it's had its ups and downs, as it always does, and we'll see workers' comp has had its up and downs in a moment. But one thing that's very, very important is that in 2025, the property casualty insurance industry probably had its best year in quite a few years. There are a number of reasons for that. We're coming off some very strong rate trends in most major property casualty lines, and very anomalous things like no landfalling hurricanes and things like that have nothing to do with workers' comp. But I will say that workers' comp was an important contributor to the good results over the past year for the industry. And that's something that's very welcome for the industry overall. And this is kind of a busy chart, but I've kind of isolated workers' compensation in here. These are the combined ratios across major P&C lines. And what you see is that workers' comp is comparable to only maybe one other major line, inland marine, in terms of its profitability over the past 5 years or so, in underwriting profitability. So what you can really see by all these peaks here, it's kind of like looking into the Himalayas, all these impenetrable, terrible peaks you have to climb. What it means is that virtually every other major property casualty line out there, other than workers' comp and inland marine, has had a terrible run of it for all but the past couple of years over the past decade or so. All right, and here's workers' comp over the past 50 years or so, underwriting results. Now, workers' comp wasn't always as profitable from an underwriting perspective as it is today. It's had some really terrible moments, and it wasn't even that long ago. 15 years ago, the industry was paying out $115 for every $100 they took in workers' comp premiums, and you could see that happened also in the early 2000s and back in the 80s and 90s and things like that. When I first came into the workers' comp business in the early 90s at NCCI, the numbers, we were up around 120 combined ratio, and even worse than that in residual markets. And so the line was a complete mess, although by the time I left, it was much better. So I always like to think about that about 5 years later, make myself feel better. But at any rate, when we look at the overall industry's premium growth, its top line over the past almost about 55 years here now. And we could see these peaks and these troughs and these peaks and these troughs, and workers' comp participated in all of these, with the exception of the most recent period of peak, and we'll talk about that in a moment. And you could see the collapse during COVID, and certainly that impacted workers' comp as well, and so did the financial crisis about 15 years or so also. So workers' comp obviously will always be a very economically sensitive line. And to some extent, so goes the industry, so goes workers' comp, so goes the economy, so goes workers' comp, but a little less so in recent years than would have been historically the case. So just to kind of give you a sense of the size and the magnitude in terms of absolute dollars and growth across the entire property casualty insurance space, what we have seen is we've moved from about a $500 billion business to a $1.1 trillion business in a span of about 15 years. So one question we'll be able to answer in a couple of minutes is, to what degree did workers' compensation participate in this, and to what degree will it participate in this growth trajectory going forward? But so we have very strong growth numbers across the industry over the past few years, although certainly a marked deceleration is underway right now. We'll talk about what the reasons for that are. Now, we have seen what I will refer in the P&C insurance world, with the exception of the past 2 years, I will call it a decade of woe. And this decade of woe is what drove premium numbers rapidly upward, in part through rate, and also through rate that was the direct result of record catastrophe activity in property lines, obviously, record problems with respect to abuse of the legal system, so torts pushing up casualty lines, non-comp casualty lines, and then the toll of inflation coming out of the pandemic, the worst inflation in 40 years. This has also had the effect of not just pushing up rate, but pushing a lot of premium into what we call excess and surplus lines markets. These are the markets where we don't have as much rate and form regulation. And this has been necessary in order to accommodate rapid growth in many challenged markets around the country, both on the property and the casualty side. So these are not residual markets, but again, these are markets where growth occurs when there's dislocation in the market overall. So we've seen tremendous growth actually running at about double the rate of the overall property casualty insurance industry, which has already been on steroids over the past few years. But workers' comp, through all of this, has actually served as kind of a calm and stable refuge, if you want to think about it, and think about it in a positive way, from an underwriting and from a profitability perspective over the past decade. It has been absolutely boring in workers' compensation from none of you will probably agree with that, but boring from kind of an underwriting perspective and a profit perspective, in the sense that things have been good, even improving a little bit relative to the rest of the industry. So we have a lot of people here from big carriers and such. I think they can probably attest to much of that. So just to give you an example, driving a big part of the rate in the P&C insurance industry over the past few years has been the record catastrophe activity that we've seen over the past 8 or 9 years or so, beginning really in 2017. Exponential increases in insured losses from natural disasters, driving a huge proportion of the premium pie upward in terms of rate. But that's not the only disaster. Let's talk about a huge man-made disaster. How many billboards from trial lawyers did you see on your way from the airport to here? Okay, those are absolute clutter. Although you can drive to Vermont, where they don't allow billboards, which is wonderful. But at any rate, you know, tort costs as a percent of GDP in the United States, and particularly in select states, continues to rise, driving up, putting tremendous rate pressure on all the casualty lines, most of them with the exception of workers' comp. And I know you talk about attorney involvement a lot, but I mean, it's way different outside of workers' comp. And then things like inflation overall. Coming out of the pandemic, inflation rose to a 40-year high. So this wound up driving up the cost of everything, not just physical objects and so forth, bricks and mortar, but also the cost of labor and these sorts of things as well. And inflation remains relatively elevated. So over that 10-year period of time, the property casualty insurance industry dug itself into a deep, deep hole in terms of underwriting losses. But workers' comp has actually been helping to fill that hole. And I'll show you how that's been happening recently. Now, but this is a big, I mean, at the end of 2025, we're in a $50 billion hole from an underwriting profit perspective just over the last decade or so, okay? So let's focus a little bit here on workers' compensation premiums written. Let's look at the top line. Looks like we come out of 2010, we come out of the financial crisis, unemployment rate goes down, wages go up, we see the exposure base go up, and workers' comp total premiums written rise as well. But there we've been roughly stuck for the better part of a decade, somewhere in this is direct premiums written, a little higher than the net numbers that you often see quoted by NCCI, but nevertheless the same kind of a story, relatively flat premium growth. So what we could see is that the workers' comp line has actually experienced negative net growth of about 2% over the past decade, 2015 to 2025. That is a very, very, very different story from the industry overall. No growth, in other words, or even a slight bit of decline relative to very substantial double-digit increases across the industry overall. So if I compare workers' comp to all commercial lines in terms of premium growth, workers' comp's the blue bar, pretty much flat, and then you see all commercial lines in orange there increasing rapidly. Just to put numbers on it, commercial lines overall over the last 15 years up 135%, workers' comp up about 41%, so that's a huge difference, and most of that growth in workers' comp came in just the first few years there coming out of the financial crisis. So a very, very different picture. Another way to think about it is in 2010, workers' comp accounted for 17% of all commercial premiums written. Today, it's 10%. So the line has shrunk tremendously in relative terms to the industry overall, and in particular to commercial lines. And in fact, overall commercial lines growth has been nearly 3.5 times faster than workers' comp over the past 15 years. So when we look at, again, workers' comp premiums written in blue there, showing the same numbers, but now we see it as a percent of commercial lines premium written. You can see how we went from about actually a peak of nearly 20% of premiums written in commercial lines back in 2015 to, again, about 10 today. So over the past decade, workers' comp as a share of the overall commercial business has shrunk by about 50%, okay, by about half. Now, that doesn't mean workers' comp is irrelevant or that it is not important. It's as important as it ever was in the sense of what it does and the protection that it provides workers and businesses across the country. But from a greater scheme of things, in terms of it influencing the top line and the bottom line of the industry overall, it plays a much lesser role than it once used to. Now, in the back of all of this, we've had a tremendous expansion in recent years of the industry's overall capacity, policyholder surplus, the owner's equity net worth of the industry after a little setback during COVID and then a setback during the period in which the Fed began to raise interest rates. But we've completely recovered from that. So there aren't a lot of constraints on capacity. And one of the reasons this is very important, because this is one of these things that is kind of untethering rate, I will say, in the sense that with ample capacity, both in primary markets and in reinsurance markets, this means that you don't really have capacity constraints as something that's holding rates up or pushing them up any longer the way they were a few years ago. And part of the reason we have significant increase in capacity is we've had 2 very profitable years in a row after a number of very poor years. So the industry did very well on the backs of much improved underwriting results and very strong investment income over the past couple of years. And that's very important in long-tail lines like workers' compensation, of course. And so, when we look at the industry's profitability, its ROE over long periods of time, this is about 40 years, you can see how volatile this is. This is something that most people never appreciate. The industry is constantly attacked by regulators in fact, we've got regulators in a bunch of states, including places like New York, looking at the last 2 years of profitability, but discounting the previous 8 years where there's a tremendous lack of profitability. So that's how they focus. But nevertheless, you can see how these profits bounce up and down, but there's been a rebound recently, which is good news. And if we go back over a very long period of time, all the way back to the 1950s, what we can see is property casualty insurers' ROE in blue is typically well below that of what we refer to as the Fortune all-industry group. Basically, think about like the S&P 500, something like that. So the industry is not wildly profitable by any measure. How profitable is workers' compensation these days? That's what you're seeing in green. So you see the overall P&C insurance industry in blue, and what you will see here as soon as this comes up, and you will see the Fortune all industry average in red, and you see workers' compensation in green. This is a beautiful picture. All right. Why is it a beautiful picture? Because what you see is workers' compensation starting off at very low levels of profitability 15, 16 years ago. These are the most recent data available from the NAIC. They only go through 2023 at this point. But what you see is a very strong recovery in profitability for workers' comp over the past 15 years. And so that's great news. So that's what I mean. Workers' comp is smaller, but it's mightier in some sense in that it contributes in a more meaningful way, in a more meaningfully positive way to the industry's bottom line. In 2010, the workers' comp was an underwriting disaster. It was a basket case. Today, it's kind of it's one of the best lines that's out there. So I mentioned that the industry is probably in the midst of a shift right now, a cyclical shift. And how do I know that? How can we see that? How can we visualize that? And what does it mean? Okay, so this is one of the same charts I showed before in terms of the industry's underwriting results. Last time I showed it just through 2025, and we're at a 94.5, okay? Really good number. And guess what? That was probably a generational, I would call it high point in terms of profitability, that came about as a result of very strong hard markets across property casualty lines and relatively benign catastrophe losses. These are unlikely to recur, unlikely to be repeated. And so what we're likely to see is some modest gradual deterioration in underwriting performance over the next several years. That's what that shows. And when I look at premium growth over the next couple of years, it's not going to be 10 or 11%, something like that. It's going to be something very modest, 3.5% looking forward, which is 3% is probably just ahead of the overall rate of inflation for this year. 3.5, maybe a little bit better than that. So much more modest growth across the industry in the years ahead. And I expect that this industry will continue to kind of be joined at the hip with the economy overall. We could see premium growth in blue, and we see GDP growth in orange here, and these things tend to track fairly well. And I think this is going to continue to be the case. The economy has slowed down markedly. But the other thing to look at is what is happening on rate. Okay, let's look. This is a survey from the Council of Insurance Agents and Brokers. They do it quarterly. And what you see there is commercial lines rate increases, basically a hard market for the back to early 2017. In the most recent quarter, fourth quarter of 2025, it's flat. Okay, so this is the smallest increase we've seen since 2017. So the question here is, do overall commercial lines descend into negative territory in 2026, or do we just kind of move sideways as we move over the next couple of years? So we're going to find that out fairly quickly. But if we take a look and drill down into individual lines, what we see now is the majority of major lines renewing in negative territory, joining workers' comp. Workers' comp has been in negative territory or flat for years and years now in terms of renewal on rate, whereas the casualty impacted lines by that I mean the abuse of the tort system lines such as commercial auto, commercial umbrella, general liability, still showing increases, but much smaller than they once did a few years ago. Over the span of the last decade, we've seen many of these lines be in the top position, commercial property, even cyber, things like that, but many of them flat or trending down today. So that suggests we might move into negative territory a little bit in terms of overall renewals. And if we take a very long perspective of this over the past 25 years, and it's a little bit of a busy chart, but I just highlighted a few things in here for you. Workers' compensation is that kind of grayish bluish line. We see workers' compensation, bringing up the rear end of this of the rate parade over the past 8 years or so, renewing lower than all other major commercial lines, and whereas you see soaring spikes in areas like property and commercial umbrella and commercial auto, things like that. Workers' comp did lead the way if we go back 15 years ago during that period of underwriting despair, the most recent one, and it wasn't far off of that kind of in the post 9/11 period, not surprisingly there. But workers' comp has been the only major P&C line that has not come along for the hard market ride because it didn't need to, because the underwriting results were strong on their own merits. There wasn't really the kind of rate need that we saw in most of the other lines. Cumulatively, we've seen absolutely tremendous rate gains in some lines, again, leading the way. Commercial umbrella absolutely stung very hard by abuses in the legal system. You see the exponential increase. You see commercial auto in a similar kind of a situation. And then commercial property from the record cat losses. But workers' comp, you see, I've highlighted there at the end, not too much of a gain over the past, actually this is 25-year period, so not too much of a gain there. So in some ways, it's kind of a tale of two stories. You'd like to see the line that you call home grow. At the same time, the reason why it hasn't grown is because the results have been so good, meaning that there hasn't been much of a need for rate. So let me get into the discussion now related to those things that are likely to impact the workers' comp line as we go forward from an economic perspective. And there are a lot of these, and again, very economically sensitive line, as everybody knows. We've had a lot of inflation that's affected not only goods, but the price of services and labor. We've had a lot of volatility in investment markets. We've got tariffs and concerns about jobs and so on, and these kinds of things. All of this has weighed kind of heavily on consumer confidence. And consumers are, they are spenders. Consumers account for 70% of GDP, consumer spending in the United States. But ultimately, consumer confidence is driven ultimately by one thing right now, and that is job security, all right? And so we're talking about tremendous labor market jitters right now that are driving down consumer confidence. All right, and we can see a lot of why are people acting that way. Job growth has slowed dramatically. Job growth is very heavily concentrated in one industry, one, healthcare, which might be good news to a lot of people in this room, okay? But what it means is we have a huge mounting structural unemployment problem here, where many people who lose jobs and find that it's taking them a very long time to get another job. It's because there's a skill mismatch out there. And then, of course, there's this fear that AI will destroy all of our jobs, unless you're in the NFL or something like that, okay? So we'll actually talk about that. I'm going to show you in a little while which jobs are safe and which jobs are not, according to a study that was done across the river at MIT recently, okay? So it must be true. So anyway, GDP growth, all right, the overall economy, been chugging along, although last year we did see the economy slow to 2.2%. We thought we'd be at about 2.7, 2.8% at the beginning of the year, but weighted down by such things as tariffs, the government shutdown, and lingering effects of inflation. So that kind of was a drag on growth last year. And growth is likely to plod along in 2026 as well, somewhere around 2.7%. But we'll have to see. There's just a little bit going on today and this time of the year, and we'll have to see what kind of impacts that has. The good news is that whereas about a year ago in April, specifically around the time of Liberation Day, so to speak, we saw a huge increase in the likelihood or the expectation of a recession developing within the next 12 months. We saw the administration back off the worst of its tariffs, although there's been a lot of movement around since then. And then we've seen the likelihood of recession, at least when you poll Wall Street analysts, recede a bit. So most recent poll was in January, and only about a 1 in 4 shot, it looks like, of a recession emerging over the next 12 months. Now we'll see. The next survey will be done next month. We'll see if any of the geopolitical turmoil we're seeing right now or rising energy prices affect that in any kind of a way. But I mentioned job jitters. Now you might say, job jitters? Why would anyone have job jitters? The unemployment rate is sitting there at 4.3%. That's just about where the Federal Reserve wants it. It's kind of at the high end of where they want it. But nevertheless, it's not too low. It's not too high. But there's more than one way to get to a low unemployment rate. Now, just take a look up the upper right-hand side here. Jobs created. We saw 2025, only 181,000 jobs created versus 1.5 million in 2024, 2.5 million in 23, and 4.5 million out of 22. Some of that was coming out of the COVID and such. But we've definitely had we're seeing job growth kind of grow to not a stall, but very, very slowly. Although in January, there's a little bit of a pickup. We'll have to see if that is sustained. But so this is the annual change in employment in the United States over the past 25 years. To put 2025 in perspective, outside of COVID, that was the worst year in terms of job creation since the financial crisis, okay, where we had huge number of job losses, of course. The years that's most closely analogous to it is all the way back in 2023, where we had a similar number of jobs created there coming out of a recession in the early 2000s. So weak in terms of job growth, and there are a number of reasons for that. We're in kind of this no hire, no fire, or no hire, or maybe some firing type economy right now. And part of this, of course, is immigration policy is clamping down on unemployment growth as well. So what would we expect for workers' comp? Well, how about that exposure base? You don't create a lot of jobs. You're not going to create a lot of new payroll exposure. You still have wage increases. Well, we saw payroll growth, wage and salary growth, 2025 of 3.8% in aggregate across the economy. That is the slowest number outside of COVID that we had seen since 2016. So definitely some slowdown in the exposure base in terms of payrolls. And we could see some of the reasons for that now. We see the number of job openings, which soared after COVID, falling now to a level that roughly where we were prior to COVID. And a few other things we could see. For instance, when we look at hiring and quits, we see on the left-hand panel, we see the quit rate has descended. It's relatively low now. It's below where it was prior to COVID. And what we see is the hiring rate, the dark line on the bottom, has fallen substantially. So the hiring rate today for businesses is somewhere around where it was in 2013, as we were kind of casting aside the last of the impacts of the financial crisis. Layoffs and discharges are beginning to tick up a little bit. These are federal data, by the way. I didn't invent these, but there are other data from groups like Challenger, Gray, and Christmas. You may have seen some of these that track layoffs. We see the same thing being mirrored there as well. Average duration of unemployment is rising. It's up about 4 weeks from about 2 years ago. So we've heard frequently how hard it is for some people to get jobs, particularly young people, including college graduates. So that's something obviously I'm very, very sensitive to and pay a lot of attention to something like that. But again, so shrinking employment growth, definitely ultimately an adverse impact on workers' comp payroll exposures. There's just no way around that. And as I mentioned, so we've got the employment changes shrinking over on the left-hand side. But on the right-hand side, what this shows is you see employment growth breaking out all employment growth except for healthcare in red. And healthcare is the top dark line there. So what this means, if you remove growth in the employment growth in the healthcare sector, there is no growth in employment in the United States. There's none. That's absolutely astonishing when you think about that. So it isn't good for all of job growth to be concentrated in one industry, okay? That is a concern that I have. It's like having all your stocks in one basket, okay? Investing just a non-diversified portfolio. If we take a look at over the past year, where was the job growth? Like you could see here, you see, 750,000 in healthcare. But you see, substantial job losses, not surprisingly, in government, given what's happened. And actually, that should say 250,000, I think, or so, not 25,000. And you see very small gains in construction, but you see manufacturing continue to decline. Transportation, warehousing, these sorts of things begin to decline. Only modest increases in some of these bigger areas like leisure and hospitality. Okay, so you put it all together and you've got very, very sluggish job growth over the past year, and almost all of it on net in one industry. What about the cost of labor out there? Well, the good news, I suppose, for employers is that the cost of labor, both in terms of wages and salaries in blue, and even in benefits, is on net declining. So it takes a little pressure off that employers have been sensing there. But if you kind of break it out a little bit more and you break down the benefits overall, you see benefit costs have been flat or decreasing recently, but what you see is health benefits have actually been soaring. So this issue of rising health insurance costs is something that's really, raising its ugly head among employers and among employees as well. Many people, maybe you, have seen substantial increases in the cost of your health care benefits provided by your employees. So these have soared up about 6.5% at year-end 2025. That is the largest increase in almost 20 years. That's material. Okay, so you got to ask yourself, will that someday, somehow translate into some kind of accelerated medical claim severity in the workers' comp side? Although, when you look at the medical component of the consumer price index, which you see in blue, that's only trending right now a little bit above the overall consumer price index, which is what you see in red. Okay, so you don't see something there, but I think that it's just not really picking up the sorts of things that it needs to. So this issue of we've been through a period of inflation. Now we're going through a period of healthcare inflation that's really affecting consumers. And what we can see is headlines, almost every week in the Wall Street Journal. On the right-hand side, health insurance is now more expensive than your mortgage for many Americans, okay? And it isn't confined to health insurance. There's a lot bad press related to other types of insurance. The uproar over affordability is coming for insurers. They're talking about homeowners and auto insurance. Okay, so insurance, not workers' compensation insurance, but most of the industry is in the news, and not for particularly good reasons right now. Now, thinking about some of the other things that are driving costs upward potentially, and actually this has been updated, so this is January through March of 2025. What we see is that, one of these cost drivers is tariffs, which have been up and down and up and down. We started last year at about 2% effective tariff rate, got up to as high as 30% around Liberation Day, and with the Supreme Court ruling, we're somewhere, depending on how you measure it, somewhere between about 13 and 15% as we sit here today. So tariffs are definitely a pressure point. That's what this shows right here. Started 2024 at 2.5% after the Supreme Court ruling, but the imposition of new tariffs that the president made, so-called Section 122 tariffs of 10% and then threatening 15%, you're up to about a 15% effective tariff rate. So again, this is a pressure point, and it is a drag on economic activity. Why? It's Economics 101. Tariffs are huge consumption taxes. There's just no other way around it. Now, let's get into the final topic here, and I'll be happy to take some questions. Everybody talks about AI all the time, and I often weave it into many presentations that I make from different perspectives. Say you want to talk about cyber-related insurance issues and so forth, and how does it relate to that? Is it an opportunity for insurers, or is it a problem? But what the narrative that the average worker who has these labor force jitters out there today is this drumbeat, this absolute nonstop drumbeat. Is AI going to take my job? Is AI a job killer? Look at all these headlines. Just last week, Jack Dorsey, who was the founder of Twitter, has another company called Block, lays off 40% of his labor force overnight. UPS cuts 48,000 jobs, citing AI as one of the reasons why. Amazon, same sort of thing. Even Dow Chemical, okay? Doomsday scenario reality. Mass layoffs, fear, fuel of AI Armageddon. These are the headlines that are going to be with us. Tens of thousands of white-collar jobs are vanishing as AI starts to bite. Well, anything that bites into the labor market is going to bite into workers' compensation exposure. All right? So again, let's first think about maybe some of the opportunities. When we think about growing exposures, think about all those data centers that are being built out there. Wonderful news if you've got exposure to the construction sector. Wonderful news for workers' compensation. Trillions of dollars being spent on data centers all over the place. It's blowing away construction everywhere else. By the way, the entire construction employment has not been doing that great, with the exception of some narrow sectors like data centers. So that's good news. And we think about this. This is a global figure, but we're looking, but a lot of this investment's in the United States. Somewhere, up to potentially as much as nearly $8 trillion in capital expenditures for data center build-out. And that includes the additional energy infrastructure that needs to go along with it. So tens of thousands of people will be employed building these data centers, building the new energy facilities and the infrastructure that we need. As we knew, AI is a huge energy hog. All right, so we need a big build out there. That's great for construction and a variety of other areas as well. So good news for workers' comp, good news for the property casualty insurance industry overall. That is viewed as a tremendous positive, actually, and you see brokers of the major carriers clamoring all over themselves to get a piece of the AI pie going forward. The bricks, the mortar, the silicon chips, the workers who are building these sorts of things, all of that. And this is occurring all over the country, and that's great news. So you see on the left-hand side where data centers are being built. Good news there. So plenty to go around. Now, a good question, though, however, to ask is, let's just take a look at maybe the threat from a labor standpoint. And I'll work through some of these charts. This is a study that I mentioned was actually from Federal Reserve Bank in Dallas, but a lot of it cites some work that was done at MIT recently. And what it shows, for instance, okay, is there any evidence that AI is creating a job apocalypse today? All right, and despite all the headlines suggest that it is. The end is near if you listen to the headlines. All right. Now in this analysis, they took a look at ChatGPT was released in late 2022, and they take a look at such things at various categories of job. They look at total job employment on the top has continued to grow since the release of ChatGPT. High AI exposure jobs in green have come down a bit, but particularly areas like computer systems design and related services. These is employment in these particular areas. So overall employment continues to rise, while some particularly vulnerable areas are beginning to drop off. Let's take a look at that. And what about wages in these areas? Okay, what this shows is that total wages have continued to rise. And it shows that, even in high AI exposure and even in computer system design and related services, we've continued to see wages continue to rise, okay, even as employment falls, okay? So what can explain that? It suggests that AI is not simply automating jobs, but it is augmenting the productivity of experienced workers. So as a result, however, entry-level workers may have a more challenging time entering the labor force, whose roles AI may more easily substitute for, okay? And that's actually what we're observing in the sense that younger people are having a tougher time in the labor force. Now, I don't mean to make an eye test here, but this comes directly out of the MIT study I was talking about. On the left-hand side these are occupations with the highest and lowest AI occupational exposure, meaning kind of risk to AI. And on the left-hand side are those that are have the greatest exposure, typically white-collar jobs requiring computational skills or very broad ranges of knowledge, the kind of things that AI can work, is very good at, that it excels at. Unsurprisingly, occupations deemed to have the lowest AI exposure over on the right. If anybody in here is a dancer, you've got it made. All right, you've got it made. If you guys are a fitness trainer, aerobics instructor, you're great. You're great right here. If your weekend thing is to erect fences, you're set for life. Okay, you're set for life. Those kinds of things. All right, but at any rate, not surprising. Again, sort of manual sort of occupations. I could do the same analysis related to industries. If I look at industries that are maybe the most vulnerable to AI, okay, you would see, actually, it lists the top 20 here on the left-hand side. It's heavily, information and financial services are the most heavily exposed, including insurance carriers, by the way, are listed right there. I highlighted that. But industries where manual labor is key are less exposed, like you might expect, all right? And, AI is going to replace me in 5 minutes here. Apparently, I've got a message, so that's okay. I'm just about done. So what about geographic exposure? What we see here is that parts of the country that are in red are more exposed, and blue is less exposed. So you have a higher concentration of white-collar labor in these red areas. So I pointed there very close to Boston. Okay, this is a very white-collar area, maybe the epicenter of the universe compared to this, and also maybe Silicon Valley, very, very red over there. Okay, blue, kind of south-central part of the country, you see less exposure. But I'll end on this positive note. There was a wonderful article in the Wall Street Journal last week by one of the best writers I consider for the journal. It says, "Tech has never caused a job apocalypse. Don't bet on it now." So neither theory, nor history, nor the latest data suggest a recession is driven by AI job dislocation, okay? And that's actually what the theme of that MIT study was, is it shows, yes, there are certain occupations that are vulnerable. Overall job growth and overall wage growth continues. So were it to be the case that there were a job apocalypse, what we would wind up having, think about the exposure base of workers' comp. You wind up wiping out millions and millions of white-collar jobs, and you wind up with an industry mix that's far more oriented to manual sorts of blue-collar jobs, say manufacturing, construction, those kinds of things. So you wind up kind of the way things were 50, 60, 75 years ago, something like that. But that doesn't seem very likely at this point, so that's good news. So again, summarizing, take a question or two. Workers' comp has been among the strongest performing of property casualty lines, which is good news. Overall premium growth over the past decade has been flat to down in workers' comp despite the employment and wage growth. And in this 8-year-long hard market across the P&C world kind of left workers' comp behind, but for good reasons. It didn't need to participate in it. So workers' comp overall accounts for a much smaller proportion of industry premiums, but it is more profitable. So it has less of an impact on the industry overall, but nevertheless, the impact that it has is much more beneficial than it was 15 years ago when the results were disastrous. And AI could have a material impact on workers' comp industry mix, but only in kind of the worst case, Armageddon, apocalyptic type scenarios. Okay, so that is the end of that, and I don't know, do I have a chance to take a question or two? No, I don't think so. Ramona says I do. Ramona says that I can take 1 or 2 questions or something like that. So I'd be very, very happy to do that if anyone would like to ask a question. I think we've got one coming up here. Yes, sir.
Hey, Bob. Great to see you, as always.
You too.
Glenn Pietrzello, Workers' Comp Trust of Connecticut. So I'm just curious with the job and labor data that you have, and given the what's been going on with immigration, undocumented workers, how is that taken into account when perhaps that payment isn't documented with that portion of the labor force?
So how is that taken into account in the analysis
job growth,
of the
unemployment, employment? Is that counted in there?
Yeah, well, I mean, what is looked at there was just aggregate growth in employment by industry or by occupation. So there's been no attempt to correct or adjust for what's gone on in immigration policy. I would say that the data in that particular study I cite start back in 2010, and they go through the middle of 2025. So the impact of more recent immigration policies is not really, I would say, fully captured in that particular analysis. If I were to speculate a little bit, I would say that part of the slowdown in things like construction employment would be the result of immigration policy, not from some AI-related apocalypse, okay? And that would be, in the research that would need to be cited separately. But for the vast majority of that data, there really wasn't that kind of immigration policy effect. But yeah, looking forward, yeah, I think that until there is some sort of a shift or accommodations are made, we're likely to see some restraint. It's not really even anecdotally anymore. If you travel to parts of South Texas and things like this and other parts of the country, there are, for instance, homes that aren't getting finished because of the fact that there is a lack of labor, certain types of labor that's absolutely critical in the construction business. So this is a disruption we're going to have, and that's the solution to this, or the resolution of this, I should say. It's a political one. It's ultimately political. It's not an economic issue per se. It is a political issue. We'll see. We'll see if there's any impact from midterms or in 2028. Okay.
Thank you.
All right. I think we're out of time now for sure. We want to keep you back on track. So thank you very much for having me here, Ramona, WCRI. Wish everybody the best of success.